SurePoint Advisors is an investment advisor in Brielle, New Jersey. SurePoint Advisors is registered with the Securities and Exchange Commission. Registration of an investment advisor does not imply any specific level of skill and does not constitute an endorsement of the firm by the Commission.
Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement by law enforcement. I am James Fay. I'm a retired law enforcement officer and now financial advisor with SurePoint Advisors. And I'm focused on helping law enforcement officers make educated financial decisions that will directly affect their retirement. I truly believe that this podcast will help accomplish that. All right, well, welcome back. We took a little time off last month in May to reassess and reevaluate this podcast and to see if it's actually doing what we set out to intend it to do, and that's to educate law enforcement officers. We got a lot of great feedback over the past 6 months in reference to the podcast and the various different episodes and topics that we touched on. So here we are back in June and going full steam ahead. We have a lot of great episodes moving forward to bring to you. So I'm excited. I'm excited for it. So today I thought we would touch on something that we touched on in a previous episode with Anthony Marone. When we were talking about mortgages, Anthony briefly touched on credit scores and how important they were. So I figured let's take that one step forward and really educate our listeners and the law enforcement community about how important credit scores are. And again, no better person to do that than Anthony Marone. So I was able to sit down with Anthony and discuss have him discuss and have you understand the importance of credit scores. So I want you guys to take a listen to that interview with Anthony. Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement by law enforcement. All right, once again, I want to welcome Anthony Marone to the podcast. Welcome, Anthony. We appreciate you taking the time to educate our listeners once again on another very important topic here that relates to mortgages. I always make it a point to inform my current law enforcement clients and make them aware of how important the credit score is and their history, their credit history, when they're either seeking that eligibility for a mortgage or some sort of refinance. So I think it's important for our law enforcement officers and our law enforcement community to recognize that there is a value to having a strong credit score when it comes to, again, refinancing or getting an initial mortgage. So first of all, welcome. How you been?
Thank you, sir. Happy to be here. Been well. How about yourself?
Yeah, all is well, thanks. Happy to be back on the podcast. Took a little vacation there for a few weeks, but we're back doing it. So maybe you can start by explaining to the listeners why having a good credit score is important and how it relates to the interest rates.
Sure, absolutely. So with credit and borrowing money is always hand in hand. I always joke around and say you only need good credit if you want to borrow money. So credit scores are good. You need a good credit score, one, to be approved for a mortgage. And then second, different loan products, you need certain credit scores to qualify for those loan products. When going into the mortgage, you typically want to see anybody, into the 700 plus range for a good score, conventional. Below that 700, you're going to be into different loan products, such as FHA, might be a little bit cheaper for you on a month-to-month basis. But definitely the credit score will affect interest rates as well. So there's different tiers of credit as you move through mortgages. And then obviously the lower credit, the risk of lending is a little bit higher, so you get a little bit higher of a credit score. If you move up an eighth or a quarter of a point on the rate, that could affect you thousands of dollars over the course of the loan. Also very important, if you were to have PMI on the file, so you can put 20% down, private PMI on a conventional product is very heavily factored on your FICO score as well. So not only will the interest rate possibly be higher because of a lower credit score, but also your PMI on the private mortgage insurance would also be higher as well. So the combination of both can affect your payment dramatically.
Right. Right. Okay. Great. So I get a lot of questions about credit score and credit report. So are your credit score and your credit report the same thing? I know some people often get these terms confused, so maybe you can clear that up for our listeners.
Sure, yeah. So the credit report's going to show pretty much any of your accounts that you have active. Credit score is obviously going to be what your credit score is. There's three types of credit score. You have Experian, TransUnion, and Equifax. The middle number of those three is your FICO score. So let's say for easy numbers, you have a 720, 725, 730. The FICO score is a 725. It's the middle of the three numbers. There's over 60 types of credit pulls out there. So if you go buy a car or you have a credit card FICO score, that FICO score is going to be slightly different than a mortgage pull. A mortgage pull is usually one of the harder credit scores, which means you're going to see the lowest FICO score. So some people, we have clients go, hey, I looked at my Credit Karma, it was a 760. You did a mortgage pull at 722. It's pretty much factored on, length of credit, time of credit established, and the reason why that mortgage is being pulled. You could do a mortgage pull today, Credit Karma is 760, mortgage pull 722, and you buy a car tomorrow and it's a 781. So there are different factors and different types of credit reports. A key thing to do with credit is, make sure that your limits, if you have a credit limit of, let's say for easy numbers of $10,000 on a credit card, make sure your balance never exceeds 30% of that balance. So you never want to have that credit card exceed 30% of your credit limits. Once you start pushing over that 30% credit limit, it tends to have a negative effect on your FICO scores. So it's a little trick. So sometimes people will book a vacation and, let's say they book a family vacation, let's say for easy numbers, it's 5,000. You have a credit line of 10, but once that 50% mark hits on a credit score, it's going to hurt their credit report a little bit. So sometimes some of my clients have to keep higher balances, higher credit lines open if they're going to do a big purchase, stuff to that nature. Never exceed that 30%. That'll definitely hurt your credit score.
That's important. That's informative too. I never really thought about the debt to loan balance. I guess 30%. That's pretty interesting. So good rule of thumb there. So
yeah, and also too, I think that
yep.
Every year you should do a credit report. If you go to like a website, I think myfreecreditreport.com or something to that nature, allows you to do a pull. With a lot of law enforcement, first aiders, stuff to that nature, I tend to see items in collections. And the reason for that is at times I see, also get hurt in a line of work. The town then gets billed a $30 fee, $100 fee, whatever it is. The town doesn't pay it, gets hit into collections. And then, 2-3 years later after the incident, we're doing a credit report and the FICO score is a lot lower than you anticipate it to be. And we look at it and there's an item in collections from an injury from 3 years prior. Also, too, I have some clients that tell me, hey, I know I have something in collections. The town didn't pay this $100. My credit score is low. Well, I tell the clients, you know about it, paid $100. Let's fight for that money back after you pay off that collection. Why have that set on your collections and your credit score gets dragged down over $100, $50? Pay it, and let's try to get the town to reimburse you for that money after it gets cleared off your credit score. Because that long-term reduced credit score is going to be a lot more expensive than $30, $50, $100 in the long run anyway. With a higher interest rate or something of that nature.
No doubt. It's going to have a rippling effect if it's not paid. So
sure,
that's great advice. Great advice for the listeners. So you had mentioned Equifax, TransUnion, and Experian as the three reporting companies. Can our listeners review their credit report, and how often?
Yeah, absolutely. So I think you can do it once a year for free. That's definitely available out there. I personally use Credit Karma as well. I just use it just to monitor my credit. So I don't really use it for my FICO score necessarily, but I use it just to make sure that everything's reporting correctly. That I can see what my balances are, if there's anything that needs to be paid. It just kind of keeps me in mind of, I know nothing's late and everything's current and stuff to that nature. Keeps me on track with everything. I know what's out there. So that's good. I definitely recommend doing that. Equifax also has an app you could download for free to monitor your credit as well. I would recommend doing a credit report probably once a year, especially if you're in the market to buy something, whether it's a car or a house sometime soon. You definitely want to monitor your credit and stay up to date with it.
Great. So this credit score thing here, what type of information does the credit score tell the lender about the applicant? So maybe you could just go over that and review that with the listeners here.
Yeah, absolutely. So one, obviously, is going to tell us your credit score. It's going to tell us what accounts that you have active, what you owe money on. So if you have car payments, credit cards, student loans, anything to that nature, it's going to allow us the status. It's going to advise us of the status of those loans. Are they in default? Are they currently active? Are they deferred for any reason? So we'll be able to see the full length of that. We're going to see any late payments that you may have had since that credit was established. We'll see the year that that credit line was established. We'll see any lates, any bankruptcies, any foreclosures, any short sales. It's pretty much going to give us a full look back, pretty much since your accounts were open on the status of the credit. On there, it's also going to advise us as well, if your credit score is a little bit on the light side or your credit score is really good, it's going to advise us why. It's going to advise us that maybe you had a few too many lates, or maybe you have excellent credit and it says you have good history of on-time payments, and that's why your credit score is good. But it's going to give us little notes on why your credit score is reflecting the way it's reflecting. Sometimes with some younger clients, we see that the length of credit established hasn't been long enough. What I recommend doing is maybe if you have kids, 18, 19 years old, maybe you add them on your credit card as an authorized user. This way it builds up their credit scores as well at a young age. As long as you make on-time payments, their credit will be a positive way. If you forget to make a payment, though, it's going to reflect negatively on that authorized user as well and hurt their credit scores. But I definitely recommend doing that if you're, if you have teenage children that are 18 plus, maybe add them on your credit card as an authorized user. They can even have that card to use if they need for emergencies, but it'll help them establish and start building up their credit at a young age.
Great.
But yeah, the credit report's pretty much like a full financial picture of everything that you've done in the past and have currently. Something else that we didn't get into yet, James, that we can do too, which is very valuable, is sometimes we'll pull people's credits. I have the flexibility of doing what if scenarios and rapid repairs on credits. So what that means is, let's say I have a client comes over to me, credit scores on a lower end. I can then review that credit report, put it in a simulator, mark certain things as paid on the credit report, or put certain balances that credit line's paid down to, and then see what their credit scores can be 30 days, 60 days, 90 days, 120 days. So we can put them on a plan. So, I've had clients where we jumped them 90 points in a matter of 48 hours. Other clients where we jump them 40 points in 3 months. Everyone's different, depends on the credit report, depends on what we could do to the system. But we have the flexibility to do that what if scenario and then pay the credit bureaus to rapid rescore instantly and reflect a new balance. So how that works is, let's say, we have somebody that has a $5,000 credit line, they have $3,000 on their card. We have them pay that $3,000. We pay it down to zero or whatever the magical number is. Sometimes the magical number is a little bit over zero. No rhyme or reason, small balance, but we'll figure that out and advise a client on where to pay it down to. Once that marks as paid, we'll then report that to the credit bureau and show them that it's paid, and the credit bureau will rapid rescore their credit immediately, and then we'll be able to pull the new updated credit score and then use that new credit score to qualify them. Other times, too, what we'll do is I'll say, we pre-qualify a client, they find a house, we have X credit score, I'll lock them in on today's date, today's rate. Throughout the next 30, 60 days, whatever the closing date is, we can work on them building their credit score up. And let's say rates rise over the next 30 or 45 days, I can go back to the day we locked that rate with a new credit score and update the rate from that day we locked it as well, which is valuable in case you're worried about a rising rate environment.
Sure. Great advice in the beginning there. Great tool to use. The what if scenario, I think that's great information. And let me just ask you, what are the scores range? Where do they range from? The lowest to the highest?
So there are lenders out there that will drop down to lower credit score lending. When that happens, we tend to see a lot higher interest rates because the risk of lending is a lot higher. COVID also had a little bit of impact on lending. It tightened up. We're starting to see a lot of those restrictions get loosened up these past couple of months. Currently for us, we're down to 620 FICO score for FHA. So that will lend down to a 620 FICO score. Conventional loans, just conventional loans are usually around a 640-ish, depending on the scenario, depending on the deal. Sometimes an FHA loan might be cheaper for month-to-month payments. And that's something that we get into with the clients. If we can't get their credit score higher or get them to where they want to be, we'll compare loan by loan scenarios for them. Say, hey, you have X credit score. We expect the credit score to stay at this point. You're doing X amount down payment percentages or whatnot. That's kind of big too, is a credit score and a down payments. because that's going to affect the overall
Sure.
monthly payment depending on what loan product we put you in. So we kind of do a full analysis of each scenario based upon down payments, credit scores, and everything of that nature, and we'll see what is
Okay.
the best loan program for them and their families.
Great. It's great. So basically, the higher the credit score, the more options that you'll have and that will be available to you, and you'll get a better loan terms and lower interest rates. So I think the range goes from like 300 to 850 is
Sure.
the range. But obviously, like you just said, somebody New Jersey lenders isn't going to loan it to anybody under 640. So I'm just trying to give these guys an idea of where their credit score should be. Obviously you want it up, in the high sevens, maybe low eights. I haven't met anybody with an 850. I'm not sure if you have, but that's pretty good if you're up there. So.
Yeah, I had a client the other day. It was a lady came over to me. She had a lower credit score. She was into the fives, and a lender was offering her to do the deal, large down payment. I think she was like 7.5% or something of that nature. And I said, do you have time? She goes, yes. So let's take the time. She has the funds to pay down some debts, clean up her credit. So let's take the time and take the 2-3 months, just get you on a track to get your credit score higher, and then let's get you a great rate, with the higher credit score, and then we'll get you into the house, and that's what we end up doing with the client. So sometimes what I recommend too, sometimes is make sure you get the pre-approval done, start the process, get the credit scores ran. This we can do an initial review, right? If we have that sit for a little while, not the end of the world. Credit reports are good for 120 days, so eventually we'll have to rerun it. Minor few points, nothing too dramatic, but it gives you enough time to be able to fix any corrections or any issues that you might have if you're worried about that, to get to a point where you're applicable for not only a mortgage but also applicable to receive a great rate.
Sure. That's what really probably stands out between you and other lenders, Anthony, is that you're not there just for the sale. You know what I mean? You're there to that service matrix that you have, and I know firsthand because I went through the process with you, is second to none, and you really do care about your clients. So that's great. Well, listen, this has certainly been a lot of information for our listeners. It's great. Am I missing anything, or is there anything else that you would like to share with our listeners?
No, I mean, that's pretty much the general breakdown of credit, at a first glimpse. Obviously, we can go into, different information regarding the credit score a lot deeper. If people have any types of bankruptcies, foreclosures, short sales, obviously you kind of put in a penalty box for X amount of time, but that will reflect on the credit scores, and maybe we can go to something else at a later date and time regarding any listeners that might have those issues. But yeah, it's pretty much the breakdown of credit. I would definitely recommend, down a Credit Karma or Experian app or something like that. Definitely monitor your credit if you're looking to borrow money in the near future. It's definitely something to work on. And we could always help out at any point in time if anyone has any questions.
Excellent. Well, once again, this has been a lot of information for our listeners. It's great to have you as an asset, and to be able to call on you for this information. It's great. I'm sure there's more topics that we can cover, that we will be covering in the future episodes of this podcast. So again, thanks again for your time, and be safe.
Thank you, sir. You as well. Thanks for having me.
All right, great. Once again, Anthony, wealth of knowledge in and around the mortgage topic. Really broke down credit scores, made it easy for us to understand the importance of them. So 10-11, prepared a copy. Let's go over a few things that were important in this episode. First thing, right? When you build and maintain strong credit, it allows mortgage lenders to have a greater confidence when qualifying you for a mortgage, because they see that you've paid back your loans as agreed and you use your credit wisely. That's important, right? Strong credit also means that your lender is more willing to approve you for a mortgage, right, that has more favorable terms and a lower interest rate, which is exactly what you're looking for. Better terms, lower interest rate. In order to accomplish that, you need to have strong credit, all right? Many people use the terms credit score and credit report interchangeably, and they're really not the same thing. So credit score estimates your credit worthiness, and it does that with a single number, right? A numerical number that you're assigned, okay? And your credit report shows more specific information related to your credit accounts. Did you pay your credit? Did you pay on time? What's your loan to debt value? Things like that, right? And lenders rely heavily on this information as it tells them your creditworthiness, right? And the likelihood that you'll repay your mortgage. So that's why lenders of mortgages look at this information and look at your credit score and your credit report, all right? Now, under federal law, you're entitled to get a free copy of your credit report from each of the 3 nationwide credit reporting companies, which is Equifax, TransUnion, and Experian. And you could do that once every 12 months. So we recommend that you actually take advantage of that and look at your credit report through one of those 3 agencies, nationwide agencies, and to make sure that there's no funny business going on, nobody else is stealing your credit or stealing your identity and taking out credit in your name. So that's important. Once every 12 months, you can use one of those 3 companies and you can get a free copy of your credit report. Very important. Scores range from anywhere from 300 to 850. Obviously, 300 being on the low end, 850 being on the high. We want you up near the 850. If you remember Anthony during the interview, he spoke about his company, New Jersey Lenders. They'll start lending to people around 620, 640. So the higher you are, the better. All right, well, that's certainly been a lot of information for our listeners in the law enforcement community. Basically, the higher your credit score and the more options will be available to you, including better loan terms and lower interest rates. Okay, so that's what you should have took away from this episode of the podcast. If you guys need to get in touch with Anthony, you can contact him direct, Team Marone at New Jersey Lenders. You can contact me here in the office, 732-876-3777. I'll certainly make that introduction to Anthony for you. You can send me your questions by email. You can find my email in the show notes or on our website, surepointadvisors.com. All right? A lot of information here that Anthony gave us. Once again, a wealth of knowledge for the law enforcement community in and around the mortgages and lending business. So with that, this has been another episode of Short Point Advisors Financial Roll Call with James Fay. We'll be 10-7 out of service.